Good afternoon, everybody. Uneducated Economist here. So before I start this video, I want to ask the question. Is the Federal Reserve trying to battle irrational exuberance? Because think about this for just a second. The Federal Reserve has been buying up an intense amount of mortgage-backed securities. And this purchasing of mortgage-backed security, all these mortgage bonds out there, has really sent the mortgage market into a spiraling whirlpool of chaos. And a lot of people don't recognize it because pretty much, when you're down here on the street level, we just look at the forbearance. We just look at the ability to postpone making our payments and then what kind of obstacles will come from that. Whether we have to pay up all the past missed payments at one shot, or if you get to roll that over to the end of the loan. But hardly anybody ever talks about what's going on with the mortgage servicers, the mortgage lenders, the mortgage-backed security investors. There's a lot going on there, and there's a lot of working parts for it. But like I said, most people just kind of pay attention to the forbearance. That's the only thing they listen to. It's the only thing that the news really talks about. So the Federal Reserve, with this purchasing of mortgage-backed securities in the intense amount they have been buying, it's a lot of it too. According to this article that I was reading, it was something like 84% of the stimulus has gone into buying mortgage-backed securities. Now, I haven't confirmed that or anything, but it blew my mind when I saw that in the article. I could not believe that's how much they've been buying. But what is going on here when it comes to the mortgage market and the retail sales, or the real estate sales, and the prices of homes? Because right now it's getting difficult to get a loan for a house. With as many people who are unemployed right now, most likely those people are not going to get a loan for a home. You have to have a substantial down payment and a really decent credit score. But yet the mortgage rates are dropping, making it less payments for a more expensive home. So when interest rates drop on mortgages, the prices of houses go up during a time when people are having difficulties making the payments on their houses. And if you listen to a lot of real estate agents, or even the economists from Zillow, there's a lot of people saying that, we may have a slowdown in the housing market as far as prices may drop a little bit, but it's only going to be 2 or 3% drop in house prices. And I have a very different opinion about that. I think house prices are going to drop, and they're going to drop dramatically. But now I'm looking at the Federal Reserve and their purchasing of mortgage-backed securities in the intense amount that they're buying, and I'm just wondering, why is it that they're doing this? Because every time they buy these mortgage-backed securities, dropping the interest rates on the mortgages out there, they are just sending a bombshell of an event into the mortgage lenders. Now, we've talked about this several times in the past, but if you're new to my channel or you haven't seen my past videos, what's going on with the mortgage lenders is that they have a hedge against the mortgages that they sign. Because mortgage lenders, they don't want the mortgage. They want to sell that mortgage. And they get you to sign the bottom line. They take that and they sell it off to somebody else. But from the time that you sign it till the time they're able to sell that mortgage, if interest rates rise, they're going to be out a bunch of money. Because just like any bond or anything else out there, if the interest rates go up, the prices go down. And so if they sell a mortgage, or if they get you to sign a mortgage, and then they go to sell it and the interest rates have risen, they're going to be out a bunch of money. So they buy a hedge against that, against interest rates rising. And that hedge that they buy, that's like their own investment. It's just completely separate from the mortgage itself. And the thing is that they don't buy it, they buy it on margin. Meaning that they use that investment itself as the collateral for the purchase of the mortgage, of the insurance policy, so to speak. So if interest rates drop, which you would think would be a good thing for them, because now they can sell that mortgage for a higher price, since if they sign a mortgage for 4% and then interest rates drop down to 3.5%, they have a mortgage that they can sell that pays out 4%. So they're going to get a better price for it. As interest rates drop, prices go up. But if this hedge that they bought is guaranteeing them against a loss, because if they sign a mortgage for 3.5% and the interest rates go up to 4%, now they're going to take a loss on that mortgage when they go to sell it. So that hedge, if interest rates drop, loses out in price. And since they bought it on margin, the brokers do a margin call. They say, hey, that security, that insurance policy, it just lost a bunch of value. And you need to come up with a bunch of money. And when they fired off that bazooka of, of liquidity into the mortgage-backed security market, when they started buying up just an intense amount of them, causing the interest rates to drop, it did a margin call on all these mortgage lenders, and they had to come up with like $5 billion. It was like a $5 billion margin call. And these mortgage lenders went to the Fed and they were like, you can't keep doing this. You do this to us and you're going to cause us to go bankrupt. We don't have that amount of cash to make these margin calls against our hedge. And the Federal Reserve was just like, oh well. And they just went ahead and kept buying an intense amount of them. So it makes me now think, it was like, well, now the lenders are having an issue with this hedge that they have purchased to protect them against interest rates dropping. Against interest rates rising. And now you got the Federal Reserve dropping interest rates on mortgage-backed securities, and these lenders are put into a bind. They are going to go bankrupt, a lot of them, if they keep this up. And from what I understand, the Federal Reserve intends on keeping this up. And now you got banks out there who are like, man, we are not refinancing your home. They'll refinance the home, but we're not doing the home equity line of credits. You got to have a 700 credit score. You got to come up with 20% down. They recognize what's going on here. They're like, nah, this housing market is not doing well. It is not doing well at all. And so I got to thinking about it. It was just like, there's a lot of moving parts in here. And so I thought, okay, well, what is the Federal Reserve trying to do here? What they're trying to do is prevent irrational exuberance. In my opinion, this is what's happening. Now, I could be wrong on this, but this is what I see, is that the Federal Reserve is trying to prevent the irrational exuberance. They're trying to keep people from taking out loans to buy homes. Because people were buying houses. I mean, you think about it. If you had to come up with 3.5% down, and you had to have at least a 600-point credit score, you could buy a lot of house out there. I mean, there was people who could go off and buy a very expensive home who probably couldn't afford it. And that's what a lot of people were doing up until this whole lockdown and everything took place. Now the housing market is pretty much at a standstill. There's less houses out there on the market, which you would think would cause interest rate or cause prices to rise because, supply and demand, less houses, bigger demand. But interest rates are dropping, which you would also think would cause the house prices to go up. But then the pool of buyers out there have also diminished. And there's a lot of people who are in forbearance, causing this problem with the mortgage servicers out there. These are the people who collect all the mortgages and pay back the mortgage-backed securities. So all these working parts together, when you get to thinking about it, with the Federal Reserve buying these mortgage-backed securities, dropping the interest rates, but it's causing the credit scores to have to go up in order to buy a home, causing the down payment to have to go up to buy a home, it's going to cause an issue with people being able to buy a house. Because like right now, if I was to go and buy a home, I would have to have a substantial down payment and a decent credit score. Where a few months ago, 3-4 months ago, 5 months ago, I could get away with having a 600-point credit score and 3.5% down. But things have changed. So what's the point of it? It's to keep the house prices elevated. It's to keep the house prices from falling, at the same time preventing people from going into irrational exuberance, buying more house than they can afford. You see what's happening here? See, the Federal Reserve's action, that one action of buying this amount of mortgage-backed securities, this intense amount of mortgage-backed securities, is keeping the house prices elevated at the same time as preventing people from being crazy with their credit or crazy with the amount of house that they can buy. It's a very mixed up situation that's going on here. Because you wouldn't think that this is what would be taking place when the Federal Reserve started buying mortgage-backed securities. You would think that when they're buying this intense amount of mortgage-backed securities, that the lenders would be able to just go like, hey, we're in the money. We got a buyer for all these mortgage-backed securities. We're going to have no problems selling loans. But yet they're sitting in a situation where their liquidity is drying up on account of the Federal Reserve's actions of dropping the interest rates on these mortgage-backed securities. I don't know. I'll leave a link down in the description for it. And I'm going to leave a link to a chart that shows what happened with the mortgage-backed securities as far as the pricing goes. When the lockdown took place and you see a huge drop in these mortgage-backed securities and then a big giant rebound. And pretty much since then, the prices of these mortgage-backed securities have been elevated, and that is the Federal Reserve doing it. Keeping the prices high, keeping the interest rates low, destroying the mortgage lending services out there, causing banks to ask for higher down payment and bigger credit scores, keeping the prices elevated at the same time, preventing people from getting a new loan. Crazy stuff. Uneducated Economist. You guys let me know.